up on a posting of this recording will be up on our DOH website, as well as the chat transcript. We will transcribe that or transpose that and post an FAQ with questions and answers from this presentation, and further questions should we get those down the line by email. I would like to ask attendees to please put your name and organization in the chat for the record, so we have a record of those that attended. And to get started, I'll introduce myself. My name is Andrew Paredes. I am the Director of the Division of Housing's Office of Housing Finance and Sustainability. And I'd like to introduce Tim Dolan, our Housing Development Program Manager, who will be presenting with me. Tim will primarily be monitoring the chat and helping us facilitate questions and answers.
Morning, all.
So we are excited to have this public information and feedback session to go over the transformational affordable housing revolving loan fund programs that were inspired and funded by Senate Bill 22-159. We are envisioning two programs. One, the Affordable Housing Investment Fund 2023 version, or what we are calling AHIF 23. And that is really kind of, we hope, inspired and improved upon our initial AHIP offering from last year. And as well, a transformational housing loan fund, or kind of DOH direct loans that are really built upon our past experience and lending through the Colorado Housing Investment Fund, or CHIF, loans that the division has been or had been making since about 2012, 2013. So we posted these draft guidelines on our website last week. The plan is to go through this webinar today, get your feedback, notes, questions before posting a final NOFA for the AHIF 23, as well as term sheet for the THLF next week, with an eye towards taking letters of interest for the AHIF 23 at the beginning of February, and initial applications coming in at the beginning of March. You see a note down there with a link to our Division of Housing Request for Applications, or RFA page. Can't stress enough that you all should check this back frequently, as we do add to FAQs and do from time to time make revisions to NOFAs and term sheets. And so before you submit applications or LOIs, maybe even as just one last double check, I suggest going back to those pages just to make sure that there haven't been any updates prior to you sending in any correspondence, letters, or applications. Next slide, thank you. So to give some background, as I indicated, these programs were inspired by or a part of legislation that passed last year, $150 million program through Senate Bill 22-159. You can see the legislature's kind of high bullet intents there, or intentions there, and we will be going through these as they relate to all of the, or both of these new programs. Next slide, please. So again, we are taking this $150 million of funding and splitting it out into what I'll go through first, our AHIF 23, and then secondly, our THLF, or DOH direct lending term sheet. So first up is our Affordable Housing Investment Fund 2023 offering, or what we will call AHIF 23. We realize that the Division of Housing will not be able to effectively administer $150 million of loans directly to applicants. So we will be relying on asking third parties, or what we call administrators, to apply to the division to access some of this capital to enable them to continue doing the affordable housing investment lending, or direct to consumer affordable housing and homeownership promotion lending that groups or agencies already do. We rolled a version of this out last year, the original AHIF, and it has proven to be successful in that third-party administrator partners have been able to access DOH capital generally within 10 days of their initial draw request. So this really does speed up the ability to get loans from the division out into the field and rely upon our third-party partners and administrators to do the loan origination, the underwriting, the documentation, and simply come to the division when funds are needed. We envision setting aside initially up to $75 million for this AHIF-23 offering. And you can see that eligible applicants are both for-profit and nonprofit administrators, as well as government-sponsored funds, in addition to CDFIs and really any other entity or financial institution that might be interested. We do encourage you to inquire with Division of Housing to see if you'll fit under the other entities as determined by DOH offering. The intent of these funds are really to be revolving, or as we put there, evergreen, meaning that they are intended for administrators to use the money to make affordable housing loans with the intent of those loans getting paid back to the administrator so that the administrator or third party can make additional loans with the same money. So really do have an eye here towards making flexible below market interest rate loans that allow for repayment and reinvestment by our administrative partners. So the AHIF-23, we are kind of learning from the initial offering, and this time around plan to make two types of offerings. And we are at the division agnostic as to which type an administrator will choose. Administrators have the option to apply for what we call a performance grant. These are really inspired by the division's current down payment assistance and single family owner occupied offerings, where we will be making grants to administrators with contractual obligations so that the division can recover unspent funds or kind of recover the funds if the administrator isn't running the program according to the contract, so that our administrative partners or administrators can take these loans and go out in the field and make affordable housing loans. The grant terms will be for 5 years, though they will be able to be renewed. And our administrator partners will pay an annual fee of 0.5% of the grant amount to the division so that the division can continue to staff this program and be able to do the reporting, monitoring, and funds disbursement as needed with our administrative partners. There will be, during the grant period, there will be no repayment required. So no kind of interest payments required, no repayment of principal required by our administrators. Although when our administrators receive payments back from their borrowers, what we call sub-note borrowers, we will require that those payments be held in a separate program income or escrow type account, so that our administrators can relend that money, but we don't want those funds to be commingled with administrators' other money. We will not be requiring any collateral assignment or guarantees from our administrators. And it's important to note that when our administrative partners receive principal and interest payments, we will be requiring that just the principal amount get put into that program income account. We will expect or allow our administrator partners to keep the interest or fees that they receive as a way to kind of operate their businesses or their loan funds, pay for their staff, et cetera. I do see, Tim, that we're getting a couple of questions. Let me go through the next guidance line of credit option, and then maybe we can stop and take questions at that point.
Yeah, Andrew, we don't have one. I think we've got one kind of queuing up here in a moment, but nothing at this minute. Yep. Thanks.
So the second option will be a guidance line of credit option. And this is very much like the original AHIF. These origination periods or lines of credit will be open to administrators for 5 years. They can come and ask DOH for loan capital kind of at any time during those 5 years to make eligible loans. the administrators will need to pay DOH interest on only the money that's drawn once it's drawn over those 5 years at 0.5%. We will require that when administrators receive both principal repayments and that 0.5% interest, that be paid back to the division. So not maintained in the administrator's program income or escrow bank account, but paid back to the division. And an administrator can then re-request that money for the next loan they want to make. And we will require that this be actually a loan or line of credit made to the administrator. So they will be required to repay this money, regardless of whether their subnote borrower repays them. There certainly can be pros and cons to either structure. On the face of it, the performance grant requires an annual fee of 0.5% of the entire grant amount, whereas the guidance line of credit can save the administrator some money because it only requires that 0.5% paid on money that's drawn. Probably the biggest difference, in addition to the required repayment and or guarantee, yes on one, no on another. So those, kind of the highlights of the two programs. Tim, I'll look to you quickly to see if we have any programmatic questions before we go on.
We have two quick questions. I'll go ahead and ask them. The first is, will DOH be making the determination on which projects will be funded and pass that on to the administrators, or will the administrators have the authority to decide which applications/projects to fund?
So that's a great question. It really gets to the heart of these programs. When an administrator makes an application to be part of this program, we will ask that the administrator, send to us their lending guidelines, their underwriting guidelines. We will review those, and putting it into maybe lending terms, we will essentially give the administrator delegated authority to approve their subloans based on their stated credit policy, underwriting policy, affordable housing guidelines, so long as the administrator is making loans according to the guidelines that the division has okayed in advance. We will not, require a DOH level approval for each funding request. We will simply ask that our administrator is certifying that they have met their pre-stated or pre-approved general lending guidelines.
Next question, Andrew, how long can the performance grant be renewed? Will any performance grant award made have to be repaid at some point? And if so, when? So
we are envisioning this as the ability for our administrators to continue to keep the program running. We've envisioned it as 5-year renewable grants so that we have a chance to take a look at administrator performance. And that's a good note and something we will think about prior to posting the final NOFA and our contracting documents, whether we can build in automatic renewals. And again, right now we're taking public comment, so you'll see a final determination on this. But what I envision might be able to be done is, so long as the administrator is running the program, according to all of the guidelines in the contracts and in good standing, they may be able to be automatically renewed. Again, we're going to ask that all of the principal repayments from your sub-borrowers to you be set aside in a program income account that is subject to the division being able to recapture if the administrator goes out of business or if they fail to be in compliance. So to the extent we're asking that funds be repaid, it's more like the division could come in and recapture program income funds, essentially the money that's been paid back to you, if you're not recycling that and using it appropriately in the future. And then, if you have notes outstanding, again, the division may, if an administrator goes out of business, say, become the beneficiary of those principal repayments. But that would be the extent of kind of the recapture or repayment idea as it relates to performance grants.
Andrew, just a similar question. At the end of the 5-year origination period, do the funds, whether grant or line of credit, get returned to DOH, or does the administrator get to keep them?
So on the line of credit, all principal repaid gets returned to DOH no matter when it is. Could be in year 1, year 4, or year 18. On the performance grant, all funds repaid must be deposited into the administrator's separate, what we call a program income account, or others may call an escrow account, that DOH also has for benefit of, or has the ability to recapture funds from. So at no point can principal repayments, if an administrator chose a performance grant, be received by the administrator and put into their general account for use in the future for some other purpose. Those repaid funds must be maintained in a program income account only for use for these program eligible activities.
I think that's it for now. Andrew?
Okay, Adam, we can go to the next slide. So now, regardless of type of avenue chosen by an AHIF 23 administrator, these are the program requirements. Essentially, we're assuming that the cost to the administrator is roughly 0.5% per year. So we're asking that in order to use these funds, our administrators are not charging their borrowers, what we call sub-borrowers, interest rates exceeding 3%. So we want to follow the legislature's intention that the end user have as low an interest rate as possible. So we're allowing our administrators to propose what their maximum interest rate is going to be. We're telling you that it can't be any more than 3% to your end borrower, but you could decide to charge no more than 1.5% to your end borrower. You could decide to charge no more than 2% to your end borrower. That's really up to you to propose to us. We are also allowing administrators to charge origination fees to their borrowers. Again, not to exceed 1.5%, but to be determined and proposed in your application to us what your max origination fee is going to be. You can see that these funds are meant to support affordable housing up to certain area median incomes, depending on the area in the state, as well as the type of lending. So, loans you'll make to support rental projects can't exceed 120% in rural and urban areas of the state, and 140% in rural resort. And then you can see the corresponding limits for homeownership projects. We are asking that all loans that you make support affordable housing for at least 15 years through either a recorded use covenant, perhaps a default or penalty rate in your loans, or alternative methods like ground lease or something like that, community land trust, as you would propose to the division. You can see the allowable uses for these loan funds, as well as eligible borrowers. So let's go to the next one. And when we get through program requirements, we'll stop again for questions. DOH, in evaluating applications from administrators, will prioritize administrators who are proposing programs that hit on these priority areas here. And this is, essentially straight out of the statute. So you don't need to hit on a certain number of these, and don't need to necessarily hit on any of these, but these are priority areas for us in reviewing applications from administrators. So from Community Loan Fund A versus Community Loan Fund B, we will take a look at what areas each person's or each group's program is proposing to hit on, and compare them to these priority areas when reviewing one application versus another. Next, Adam.
Andrew, I think we have a couple of questions before we get too far ahead here.
Then, Adam.
The first question you may be covering in a little bit is for the line of credit. What will be the turnaround time for DOH approval?
So I haven't yet hit on that in either of these, but the current version of our AHIF states a turnaround time of 10 working days, or effectively 2 weeks, from when a loan fund sends their draw request to the division to say, we would like to close on a loan. We'd like to make an $800,000 draw against our AHIF program. The division is then going to turn those requests around in 2 weeks. And to date, we've been able to meet or exceed that stated turn time on the current version of AHIF and expect to be staffed accordingly to continue that.
And then this may relate to the previous slide, but for the AMIs, is that 50% of the units or 100% of the units?
Will you go back, please? Thank you. Right now, that intent is for 100% of the units. But again, this is where we want to get your feedback. So please do put any thoughts you have on how we should do that in the chat for consideration as we finalize these guidelines.
And one more, Andrew, I think this relates to the terms of the loans. It says, since permanent affordability scores higher, why even allow 15-year restriction? Does that not create a cliff we don't want to see down the road? I think this is related to the 15-year term on the next slide.
Gotcha. I think I'll take that under consideration. I think that, we want to kind of allow for as much flexibility to your end borrowers as they need. So the division is talking about a minimum long-term affordability period, meaning if Loan Fund A is proposing to make a loan to affordable housing developer, we're asking that Loan Fund A require that their affordable housing developer customer ensure affordability for at least 15 years. It could be more. Again, I welcome the comment. I don't know that I have a perfect answer or a well thought out for that yet. So I will kind of defer to the FAQs on that. But please do put in the chat, or as you'll see at the end, our email address for more thoughtful feedback and questions or advocacy for what you think we should do.
And then, Andrew, just one more for the time being here. Are administrators making a per project draw or a one-time draw for the full amount being requested?
They will be per project draws. And so, per loan that our administrators are making, they will request the money they need for that loan. And then once the administrator has drawn all of its grant money out of the DOH coffers and has built up money in its program income account, we are still going to ask them to send in a draw request for authorization to make subsequent loans out of that program income account. Again, this is a way that the division can keep an eye on activity and make sure that the end uses of this money, even into the future, continue to align with the program requirements and guidelines.
We have a couple of advocates for the longer affordability, but you'll see those in the FAQs later.
Gotcha. Thank you.
Yep.
So Adam, let's roll forward. What back one? So these are what we are posting to potential applicants for AHIF 23. You all will certainly be telling us what your underwriting guidelines are and what your credit policy, your lending guidelines are. We are saying that we would like to see your lending practice be, to hold to a minimum of a 105 debt coverage ratio. You may be different. You may only lend out at a 110, or you may be comfortable going down to a 1.0% with, certain other financial backing or guarantee. That's great. We're just kind of telling you what we think kind of vanilla down the road underwriting guidelines ought to be. You are certainly welcome to come to us with applications that have different guidelines here and explain why. That's fine, but we're just kind of giving you the things that we'd like to see you underwriting to. But again, we have, even in AHIF, we approved applications that had differing guidelines. That's okay. We definitely don't hold that against anybody sight unseen. I'm just kind of giving you some preferred guidelines as to how you're making loans with this money. Next, Adam. So what are the next steps for administrators who would like to apply to be an AHIP 23 participant? We'd like to get a letter of interest or an LOI by February 10th. And we'd like you to submit that to Laura Kane here at the Division of Housing. Laura is our administrative assistant in the Office of Housing, Finance, and Sustainability. So she'll be able to receive all of those, confirm receipt for you, and make sure that it's getting to the right staff person. We'd then like to get your application by March 1st, at which point DOH staff will be reviewing the applications from administrators and writing up our staff analysis, perhaps also having a meeting with potential administrators to go over your application, and then presenting recommendations of approval to our State Housing Board prior to going to the contracting process.
Andrew, I think we have, if I could just interrupt with one more question with regard, this looks like it relates to the drawdown. Is the initial LOI/approval being approved to be able to use the funds, or would that not be submitted until an administrator has a project ready to fund?
So no, thanks for that clarifying question, whoever wrote that. I'm glad you flagged it, Tim. You need to make application LOI by February 10th and application by March 1st to receive your program approval to use the funds. So absolutely, if you think that you'd like to do a $5 million loan fund to support affordable housing in a certain area for certain types of housing, you must LOI by February 10th and apply by March 1st, even if you don't actually draw those monies until the end of this year. So absolutely, applications to be part of the program, whether you draw the money immediately or not, need to come in by March 1st and LOI by February 10th. So please do not miss those deadlines. Any others on AHIP 23 at the moment, Tim?
No, I think you're good to go.
Okay, so now I'm going to shift gears and talk about the Transformational Housing Loan Fund, or THLF. These are essentially DOH direct to borrower loans. So again, these are very much in the spirit of our current offerings of the Housing Development Loan Fund, what we call HDLF, and the Colorado Housing Investment Fund, or what we call CHIF. So these are essentially loan options that developers, housing authorities, governments, sponsors can apply directly to the division to access. You can see, and the division will approve each individual application and make the loans directly from the division to the borrower/developer. You can see that borrowers eligible are for-profit and nonprofit affordable housing developers, local governments, and political subdivisions of the state. Eligible projects, important that you see that's including but not limited to. So if there are additional projects, they may very well be eligible, and kind of on a case-by-case basis with your application to the division. And eligible uses kind of spans just about all food groups, I think, within the affordable housing development lending arena. Next, please, Adam. So we have here proposed maximum loan amounts of $5 million or $100,000 per unit, whichever is less. Loan terms less than or equal to 10 years or commensurate with senior debt. So if somebody were doing a development where the senior loan was 15 years and they would like to get a second mortgage or mezzanine debt directly from the division would entertain a request for the division's loan to also be 15 years or 15 years and 6 months, whatever is palatable to the developer and their senior lending partner. The division will hold interest rates under 3%. The division will charge fees very much in line with the way we operate our CHIF and HDLF programs currently. And applicable third-party fees, those refer to perhaps appraisals required, phase ones required. If we're contemplating doing a construction loan that the division may be the primary lender on, we may require monthly draw inspections from a fee inspector. Those are the third-party fees that we're talking about there that would be the responsibility of the borrower. And again, we intend for this to be as flexible in repayment as possible to our borrowers. So wanting to use this money to leverage other lending partners, other capital sources, make affordable housing deals possible, but also know that the statute really does ask the division to keep an eye on these funds and ensure to the best of our ability that they do get repaid and are evergreen and reusable in the future. So, while we intend and aim to be as flexible as possible, there will be some underwriting standard here that we're underwriting deals to make sure that they do have the ability to pay these loans back so that these loans can be used for the next deal and the deal after that.
Andrew, we have one question that I'll go ahead and state. I'm not sure where the appropriate people to answer this, but it says, does a metropolitan district qualify as a political subdivision?
I'm going to go out on a limb and say yes, and we will give you a formal answer in the FAQ. But I think certainly a metropolitan district would likely qualify as one of the eligible borrowers, as the legislature really did kind of intend for eligible borrowers to be just about anybody who will be proposing to develop affordable housing. But we'll formalize that in the FAQs. So you can see here the metrics that we will be using in our underwriting guidelines. Maximum loan to value or loan to cost, whichever is less of 95%, as well as a debt coverage ratio of minimum of 105. The division will, I think by term sheet, on a deal basis, offer a rate lock of up to 12 months. So, again, trying to be flexible and trying to be helpful to our development partners that they know they can count on kind of interest rate origination fee levels for a certain period of time. Again, we're going to ask for a minimum of 15 years in affordability as subject to the same AMI limitations. So next steps for this THLF program is that we will post a final term sheet that prospective developers, borrowers, deal level direct to DOH borrowers can look at, and we will begin accepting applications monthly like our traditional gap funding application rounds each month beginning on March 1st. And applications will be submitted like other direct to DOH applications through the Neighborly portal with the assistance of your Division of Housing Development Specialist every month.
One new question, Andrew, is what is the difference between THLF and DOH's existing gap funding programs?
It may turn out that there aren't as many, although I think that the THLF isn't designed to absolutely be gap funds. It could be that THLF may be requested and used as kind of mini perm or mezzanine debt to take the place of a bank's debt, or the developer may have a bank that's willing to lend up to 60% of loan to cost. But the property may support more debt than that. The developer may come to the THLF program and ask if the division would make a second mortgage or a mezzanine debt up to 75% of the cost, and therefore be able to kind of unlock that traditional bank debt with some maybe more risky DOH debt. And that's not necessarily gap funding. That's more kind of stepping in and maybe credit enhancing. I don't know if I want to use that term because we're not talking about that, but kind of additional leverage. Adam, we can see the
He's putting the links in the
the cutting and pasting. I appreciate you doing that. Probably putting that in the chat. So thank you. Any other questions, Tim?
Not at the moment.
So again, going back to the important dates, Adam, if you would go back real quick to the AHIF 23 important dates. I really want to stress and emphasize again that initial question that we got. I think it was actually forward. Sorry for making a few folks dizzy with this, but if you want to be one of those AHIF 23 administrator participants, please be sure that you are sending in your letter of intent by February 10th and making your application for AHIF 23 by March 1st. Even if you don't anticipate actually making loans to your end user borrowers until after that, you still need to apply to be part of the program by those dates. And those are very important. So want to emphasize, please do that.
Andrew, we have sort of an important clarifying question here between our ongoing programs, existing programs, and these programs, which is for DOH's ongoing programs, will these new higher workforce AMIs apply, or are they only for these specific programs?
Right now, they are for these specific programs, as they were part of the legislation that generated, this program or both of these programs, and anecdotally, as well as the legislation that generated our transformational grant programs and our mobile home acquisition programs. So right now, those are the AMI limitations for these programs only, as kind of outlined in the originating legislation. I also want to highlight that the AHIF 23 programs are we anticipate or would be excited to get applications from, affordable housing lending funds that make loans to developers. I'm trying to using that as a very generic product, but also from community housing funds that make home ownership type assistance loans directly to individual home buyers. They are also an eligible applicant to the AHIF 23. So, again, being as generic as I can, if there were a community nonprofit partner out there that made down payment assistance loans to home buyers in their specific community, they would be an eligible applicant, and we would encourage and hope to see applications for that use through the AHIF 23 as well. Didn't really touch on that too much in the underwriting guidelines.
No other questions at the moment. I guess we have one here. Does the admin have to be based in Colorado?
That's a good question. And we're going to take that under advisement and publish that in our final FAQs, as we will want to go over the legislation as well as have our policy and council people go over that so that we're answering that correctly.
I have another question here, Andrew. It says, it noted limited uses for preservation and rehab. Can you expand upon that?
We will post those in the final NOFA, as the legislation had some fine print, I'll call it, that kind of really got specific, although it allowed for a dozen different uses of preservation. But I didn't want to busy the slides with all of the fine print, but they will certainly be in the FAQs and or final NOFA. So please do take a look at that. But those are things that we don't have a lot of leeway on, as they were part of the SB22 159 legislation.
One more question. For a mixed use projects, are THLF maximums based on number of affordable units?
We will answer that with a written FAQ as well, as I don't want to over or understate and get it wrong. We'll want to kind of consult the legislation as well as our policies and programs. So thanks for the question. So again, thanks, Adam. As I said, please be sure that you are double and triple checking our latest applications page on our website to make sure you're not missing any revisions to either FAQs or NOFAs themselves prior to submitting any letter or application. And then a good way to stay on top of things when we do post for FAQs or NOFAs and requests for applications is to sign up to be part of our DOH News Blast mailing list. That way you'll be, you'll get notification that things are open or posted.
And then one last question, or I don't know if it's the last question, but another question with regard to LOIs and applications. Will there be a published list of the administrators who are granted this funding for smaller organizations to know who to apply to?
That's a great question. It kind of takes it one step further than we've been going so far. So I'll go through all of them. We intend to publish a list of the LOIs that we receive. We also intend to publish a list of the applications that we receive. And then I think that I love that question and prompting. I think it would be very beneficial for us to publish a list of the awards so that, as you say, agencies, developers, homeowners can see, administrators who receive funding and be able to contact those administrators for access to their loan products. Thank you very much for that idea.
Okay. Perhaps we should take a last call for questions here. Here's one. Can administrators limit the geographic locations in which they lend?
Yes. So, and we would like that as part of your application for you to tell us, the market that you intend to serve. So both geographic and kind of income band, housing type, that kind of thing. So, happy to take any more questions. We'll stay online here for a couple more minutes and then we'll wrap up and remember that we will be posting recordings of the webinar as well as FAQs based on the chat in the probably week to come.
Andrew, what do you anticipate the average award size to be for AHIF?
I do not have an answer for that, as the pool is up to $75 million. Likely depends on the strength of the application, the number of applications. So don't want to pin down on that. We intentionally didn't put an expected average size, simply a maximum. Well, I think we will also say thank you, wrap up this public information session. Please feel free to email further questions to either Tim or me so that we can take your feedback into account, do our best to answer them, and look for posting of the final NOFA next week and the LOI deadline for AHIF 23 of February 10th. So thank you all, everybody.
Thank you.
DOH folks, let's stay on the line until everybody has hung up and we can end the recording.